Have you ever felt like you're working harder than ever, but somehow you're just falling further behind?
Oh, yeah. I hear that constantly.
Right. I mean, you put in the hours, you finally get that promotion, you meticulously save what you can from every single paycheck, and yet the goalposts just keep moving.
They do. They really do.
Like the house you wanted to buy is suddenly entirely out of reach. The grocery bill is just startling. And, that feeling of genuine financial security feels like water just slipping through your fingers.
Yeah, it's incredibly frustrating.
So if you've been lying awake at night wondering what you're doing wrong, you really need to hear this because you are absolutely not alone.
No, not at all. It's a universally shared frustration right now. And I think the most important thing to internalize right from the start is that this it's not a failure of your personal work ethic.
Right. It's bigger than that.
Exactly. You are basically playing a game where the rules are quietly being rewritten while you're out there on the field. I mean, we are living through a fundamental shift in the whole global economic architecture.
Which perfectly brings us to the core of what we are unpacking today. We've pulled together insights from a really wide array of sources for this deep dive.
Some really heavyweight stuff.
Yeah, exactly. We're looking at macroeconomic research from Crescat Capital, global wealth data from Boston Consulting Group, some behavioral frameworks on wealth preservation, the algebra of wealth framework, and even a viral video essay on the invisible forces that kind of dilute our money.
It's a lot of ground to cover.
It is. But the mission here is really to decode the hidden mechanics of how wealth is actually created, diluted, and preserved in a world where, honestly, inflation just feels increasingly permanent. We want to give you a clear, actionable roadmap to navigate all this.
Yeah, because to build wealth, you can't just look at your own paycheck or your own budget anymore. You have to understand the invisible plumbing of the entire financial system.
The plumbing. I like that.
Because if you don't understand how the money flows at a macro level, you're basically going to end up paying for the leaks.
Well, let's start with those leaks,
Mm-hmm.
because one of the most compelling arguments in the research we looked at centers on how new money actually enters our economy.
Right.
Like we are constantly told that inflation is just a byproduct of, I don't know, supply chain glitches or maybe corporate greed or just consumers buying too much stuff.
Yeah, the usual suspects.
Exactly.
Mm-hmm.
But the research points to a much more mechanical, structural process.
Yeah.
It argues that inflation is basically baked into the system by design.
Yeah, and the term for this phenomenon is the Cantillon effect. It's an economic principle named after an 18th century banker, and it explains the actual mechanics of monetary expansion.
Okay, so how does it work?
Well, the core insight is that when a government or a central bank prints or injects new money into the economy, that money does not magically appear in everyone's bank account all at once.
Right, it's not evenly distributed.
No, not at all. It enters the economy through very specific valves. It enters through the banking system and large financial institutions first.
So they get first dibs.
Exactly. These entities get access to this freshly minted liquidity before the broader economy has even registered that the money supply has increased.
Wow.
So they take this new capital and they use it to buy hard assets. Real estate, massive apartment buildings, shares in major corporations, commodities.
Oh, I see.
And they are buying these assets at yesterday's prices, using tomorrow's money.
I kind of think of it like a VIP line at a highly anticipated concert.
Oh, that's a good way to look at it.
Yeah, like the VIPs get led into the venue an hour before anyone else. They go straight to the merchandise stand, and they buy up all the best shirts at a massive discount.
Yep.
And then by the time the general admission line finally gets through the doors, the prices have been jacked up, the best inventory is totally gone, and the people at the back of the line are left paying a premium for whatever happens to be left over.
That is strikingly accurate. The mechanics of the economy work in almost that exact same way. By the time that newly created money trickles down through the whole corporate structure and eventually shows up as, say, a 3% raise in your salary, the inflation has already set in.
Right, the prices are already up.
Exactly.
Right.
The cost of living has adjusted upward. Suddenly, you notice your rent jump by 15% or your grocery bill goes up by 20%.
Which is what everyone is feeling right now.
Right. The purchasing power of your physical cash has been diluted, but the people who bought the assets at the front of that VIP line, well, they've seen their net worth just soar.
And the data on this wealth gap from the sources is just staggering. If we look at the M2 money supply, which is essentially a measure of all the cash in circulation, plus checking accounts, savings, easily accessible funds.
Yeah, the broad money supply.
Right. Between 2008 and 2024, the U.S. M2 money supply expanded from roughly $2 trillion US dollars to almost $20 trillion US dollars.
It's an astronomical increase.
10 times. And if that newly printed wealth benefited everyone equally, we'd all feel incredibly rich right now.
But we don't, because the distribution of that expansion tells the real story. During that same window, the wealth of the top 0.1% grew by an astonishing 200%.
Wow.
Meanwhile, the bottom 50% of the population saw only a 12% increase in their wealth.
That is such a massive disconnect.
And real wages, meaning your actual purchasing power after adjusting for the rising cost of goods, they basically stayed flat. It is a mathematical certainty based on where the money enters the system.
And, it's really important to clarify here that we aren't taking sides, and this isn't about which political party is occupying a specific office. This is simply the mechanical reality of how modern central banking functions worldwide when dealing with massive sovereign debt.
Right, impartial reality. Governments have to print money to service their debts, which inherently dilutes the currency.
And this monetary dilution seems to be shifting from like a temporary crisis measure into a permanent fixture.
Yeah, that's what the macroeconomic analysts are saying. They're looking at historically high global debt levels and concluding that tight monetary conditions are mathematically unsustainable.
Meaning they can't stop the printer.
Basically, governments will eventually have to use monetary dilution as a relief valve, meaning we are likely entering a really enduring era of sticky inflation.
And the research highlights a really fascinating, kind of funny metric to prove this structural shift. The Big Mac Index.
Yes, the Big Mac Index.
It's an informal, but actually highly effective way of measuring purchasing power parity across different countries by literally looking at the price of a standard McDonald's burger.
And the findings there represent a complete reversal of historical norms.
Wait, really? A complete reversal?
Yeah, because for decades, emerging markets struggled with wild inflation while developed economies enjoyed relatively stable prices. But the index now shows that developed countries are paying significantly more for a Big Mac than emerging markets.
Oh, wow. So the developed world is feeling the squeeze harder on the basics.
Exactly. The lack of fiscal discipline in the developed world has fundamentally entrenched a higher cost of living.
Okay, so if traditional cash is essentially a melting ice cube, where is the smart money going to, stop the melting? The reports point toward a massive macroeconomic pivot toward hard assets.
Yeah, and we are seeing this pivot at the highest institutional levels. Central banks themselves are aggressively changing their behavior.
Ah, cool.
Look at China, for instance. They are currently battling severe economic stagnation. It's what economists refer to as a Japanification of their economy.
Right.
To combat this, their M2 money supply has ballooned. It is actually double that of the U.S., despite China having a smaller overall economy.
That's crazy.
It is. So to hedge against the massive pressure this puts on their own currency, the Chinese central bank is hoarding gold at historic rates.
And the BCG global wealth data totally backs up this trend. While equity markets have seen gains, gold has been an absolute standout, surging roughly 44% recently.
Yeah, it's being driven by this deepening global unease about the long-term stability of fiat currencies.
But this shift to hard assets completely upends conventional investing wisdom, doesn't it? I mean, for decades, financial advisors preached the gospel of the 60-40 portfolio.
Oh, the classic 60-40.
Yeah, put 60% of your money in stocks for growth and 40% in government bonds for safety. The bonds were supposed to be the shock absorber.
Right, but the problem is that the shock absorber is now broken.
How so?
Well, because of entrenched inflation, US Treasuries, government bonds are currently experiencing higher volatility than gold for the first time in 45 years.
Wait, bonds are more volatile than gold? That sounds backwards.
It does, but we need to look at the math behind why this happens. Bonds pay a fixed yield. If you buy a bond paying a 3% yield, but inflation is running at 5%, your real return is negative 2%.
So you're basically locking in a guaranteed loss of purchasing power.
Exactly. And when massive institutional investors realize this math, they dump the bonds. That aggressive selling causes the price of the bond to crash and swing wildly, completely shattering its reputation as a safe haven.
It's like buying a heavy winter coat that looks incredibly durable, but it's made of a chemical material that literally dissolves when the temperature drops below freezing.
That's a great analogy.
The very instrument designed to protect you from harsh conditions reacts terribly to the actual environment.
That captures the dynamic perfectly. The so-called risk-free asset has introduced immense risk into portfolios.
Okay, I do have to push back on one thing regarding hard assets, though.
Sure.
If gold and other physical commodities are so clearly the ultimate defense against currency dilution right now, why have the companies that actually dig this stuff out of the ground, the gold mining stocks, been struggling for so long? It feels like a glaring contradiction.
It is a vital question, and analysts refer to this as the CapEx dilemma. CapEx stands for capital expenditure. You have to consider the physical reality of the metals and mining industry. There is an incredibly long duration from the moment a geologist discovers a mineral deposit to the moment a company is actually producing sellable metal.
How long are we talking?
We are talking about a lead time of a decade or more. You have to secure environmental permits, raise billions in funding, and build the massive infrastructure required.
So it's not like a tech startup where you just, write some code, rent server space, and push a software update to millions of users over the weekend.
Far from it. Because of heavy regulatory pressures, environmental concerns, and years of depressed investor interest in the sector, these mining companies haven't been spending the necessary capital to build new mines.
Right.
So when the price of the physical metal spikes today, the companies don't immediately see the profits because they don't have new product coming out of the ground.
Ah, I see.
Their stock prices naturally lag behind the metals price. However, historically, when metal prices remain elevated for a sustained period, the miners eventually catch up, their margins explode, and they experience a massive boom.
Interesting.
Yeah, the macroeconomic data suggests this historical lag is actually a heavily disguised opportunity for investors right now.
Okay, all this macro theory is fascinating, but let's bring it down to the individual level. I can't just decide to act like a central bank and print my own money to buy an apartment complex or a gold mine.
No, you definitely can't do that.
So how does a normal person actually generate the initial capital required to play this game?
Well, we can turn to a highly regarded framework in the wealth management space, often called the algebra of wealth. It provides a very practical formula for navigating this exact environment.
Okay, what's the formula?
The formula posits that wealth equals focus plus the combined power of stoicism, time, and diversification.
Let's break that equation down, because the first variable, focus, actually challenges some very deeply ingrained career advice.
It does.
The framework insists that true wealth building starts with focusing your human capital, not your financial capital.
Right. Human capital is your time, your physical energy, your specialized skills, and your creativity. It is your primary economic engine.
Okay.
The key insight of this framework is that you must concentrate that human capital relentlessly into a narrow, highly valued area.
I struggle with this a bit, honestly, because society constantly bombards us with the message to just follow your passion.
Oh, absolutely.
We're told that if you love what you do, the money will naturally follow and you'll never work a day in your life. This framework seems to just throw cold water on that entire philosophy.
It completely inverts that philosophy.
Yeah.
The research argues that following your passion is often a dangerous trap for young professionals.
A trap.
Yeah. If you happen to be passionate about something the market doesn't value monetarily, you will struggle. Instead, the advice is to focus your human capital on a skill that the current market desperately needs and is willing to pay a premium for.
So supply and demand apply to your career.
Exactly. Find an area where you have a natural aptitude, become exceptionally, unignorably good at it, and the passion will follow.
That makes sense.
The passion comes from the mastery, the respect of your peers, and, quite frankly, the immense financial security that your highly concentrated human capital provides.
So you become almost mercenary with your skill set. You laser focus your career to maximize your earning power.
Yeah.
But once you have that high income stream, how does the rest of the equation work?
Then you apply stoicism, time, and diversification. Stoicism, in this context, is about extreme financial discipline. It's the psychological ability to resist lifestyle inflation.
Oh, that's the hard part.
It is. When you get a massive promotion, the natural urge is to upgrade your car, your house, your vacations. Stoicism is realizing that wealth is defined by the gap between your ego and your income.
The gap between your ego and your income. I like that.
It's about what you keep, not just what you make. You save that surplus capital and you give it time to compound.
Which leads right into diversification. So you concentrate your effort and your human capital to make the money, but you diversify your financial capital to keep it.
That is the crucial pivot. You take concentrated, aggressive risk in your career trajectory, but you transition to a highly diversified defensive posture with your investment portfolio, so a single bad decision can't wipe you out.
To really ground these concepts of hard assets and focusing on market demands, let's look at a fascinating real-world collision happening right now from the sources. Let's talk about the country that analysts call the Saudi Arabia of copper.
Ah, you were referring to Chile.
Yes, Chile currently produces roughly 27% of the entire global copper supply. They are the absolute linchpin of the world's physical infrastructure.
They are.
Yet, due to a mix of political changes, lower ore grades, and a lack of new investment, their copper production is currently sitting at a 12-year low.
Now, overlay that 12-year low in supply with what is happening concurrently in the technology sector. We're in the middle of a generational explosive boom in artificial intelligence.
The AI boom.
Right. And the physical infrastructure required to support AI is unbelievably energy intensive. To put it in perspective, the reports indicate that a single request to a generative AI platform consumes about 17 times more energy than a standard internet search.
17 times the energy demand for a single query. When you multiply that by billions of users, the sheer scale of the electricity required is just difficult to comprehend.
And what is the fundamental material required to conduct all of that electricity?
Copper.
Copper.
You have the global green energy transition, the mandate for electric vehicles, and now the massive unrelenting power demands of AI data centers, all screaming for an expansion of the electrical grid.
So we have a structural, exponential explosion in demand for a physical commodity occurring at the exact moment the world's largest producer is hitting a 12-year low in supply.
It is the ultimate supply and demand mismatch, and it beautifully illustrates why hard commodities are becoming the ultimate hedge against a financialized economy.
Because you can't just print it. Exactly. Governments can print infinite amounts of fiat currency to fund AI research or subsidize energy, but they cannot print a single ton of copper. The physical reality of the Earth's crust is finally asserting its dominance over digital spreadsheets.
Okay, let's follow this timeline. Let's say you take all of this to heart. You focus your human capital in a high-demand field like AI infrastructure.
Okay.
You practice stoicism, you avoid lifestyle creep, you invest heavily in hard assets, and you successfully beat the Cantillon effect. You build significant, multi-generational wealth. What is the next hurdle?
Well, this is where the academic research on systemic wealth audits becomes critical. We are standing on the precipice of the largest transfer of capital in human history.
The great wealth transfer.
Yes. Financial analysts estimate that roughly 84 trillion US dollars will be transferred from the baby boomer generation to their heirs over the coming decades.
The scale of $84 trillion is almost unfathomable. But the academic research on what happens to that money after it changes hands is actually quite grim, isn't it?
The statistics are a massive wake-up call. Studies indicate that up to 70% of that inherited family wealth will be completely evaporated by the end of the second generation.
70%.
And up to 90% of it will be gone by the third generation.
I genuinely struggle to wrap my head around those numbers. I mean, if my parents hand me $2 million, I feel like I would have to actively try to set it on fire to lose it that quickly. How does that kind of wealth just disappear?
The methodology refers to the root cause as structural blindness. Families generally view wealth through a very narrow, singular lens, which is investment returns.
So just looking at the portfolio.
Right. They spend all their time obsessing over picking the right growth stocks or timing the real estate market. But the true measure of long-term financial survival isn't just asset appreciation, it's structural sustainability.
So it's about looking at the entire ecosystem of your financial life rather than just the single pillar of your brokerage account.
Correct. A proper systemic wealth audit requires analyzing 6 interconnected domains: financial position, protection, investments, tax, retirement, and estate planning.
Okay.
Families lose their wealth because they might be brilliant in the investment domain, but they are completely blind to the others.
Let's detail how these domains interact to cause a failure. Give me an example of structural blindness in action.
Okay, imagine a family that has built a beautiful $2 million US stock portfolio. They feel incredibly secure, but they neglected the protection domain. They don't carry a personal umbrella liability policy.
Oh.
One day, a teenager in the family gets into a severe car accident causing major injuries to another party. The family is sued for damages well beyond their basic auto insurance limits.
Wow, okay.
To pay the massive legal settlement, they are forced to liquidate their stock portfolio. Because they liquidated so much at once, they trigger a catastrophic event in the tax domain, losing another massive percentage to capital gains.
So the unpatched holes in the boat sink the ship, regardless of how strong the engine is. It's not the stock picks that ruin them, it's the structural errors.
The academic models call this the cost of error. For a family trying to preserve wealth, success isn't about finding alpha, outperforming the stock market by a few percentage points. Success is about preventing catastrophic loss through structural blind spots.
And the research points out that this isn't just a concern for billionaires with family offices. It specifically highlights the vulnerability of the messy middle.
The messy middle, yes.
Families who have accumulated a nest egg of $1 million to $2 million US dollars. They're the ones most terrified of seeing a lifetime of work wiped out by a medical event or a lawsuit.
Yeah, for the messy middle, $1 million provides comfort, but without rigorous planning, heavy estate taxes or a long-term care need can evaporate it instantly.
So what are the solutions for them?
The solutions aren't necessarily complex offshore tax havens. They are foundational tools. Utilizing revocable living trusts to avoid the massive legal fees of probate, constantly updating beneficiary designations, and most importantly, transparent family communication.
Communication is key.
It really is. If the next generation doesn't understand the mechanics of the wealth or the discipline required to maintain it, the statistical probability is that they will squander it.
Man, we have covered a massive amount of ground today on this deep dive, from the plumbing of the Cantillon effect to the energy demands of AI, all the way to the mechanics of generational wealth loss. Let's synthesize this into the WealthNetics style. What are the immediate actionable takeaways for the listener?
The first takeaway is a fundamental mindset shift regarding how you view your money. You have to transition from thinking solely like an employee to thinking like an owner.
Think like an owner.
Yes. To survive the Cantillon effect, you must position yourself as close to the creation of new money as possible. You do that by owning hard assets and productive equities.
Even small amounts.
Absolutely. Even if you are just starting out, buying fractional shares of real estate or index funds means your net worth inflates alongside the system. If you only hold fiat cash, you are permanently stuck at the back of the VIP line.
Okay, takeaway number 2. Radically focus your human capital. We live in a hustle culture that encourages people to spread themselves incredibly thin across 5 different mediocre side hustles.
Yeah, you have to stop diversifying your skills.
Right. Identify a massive macroeconomic wave, whether that's the energy transition, AI infrastructure, or highly specialized trades, specialize deeply and become an invaluable master in that niche.
Yeah.
Use that concentrated earning power. Apply rigorous stoicism to your lifestyle and use the surplus to buy the assets we just talked about.
Spot on. And the third takeaway is to conduct a systemic wealth audit on yourself this week. Stop obsessing over the daily fluctuations of your retirement account and look at the structural integrity of your financial life.
Check the blind spots.
Exactly. Do you have a legally binding will? If you have dependents, is your life insurance actually sufficient to replace your human capital? Are your current investments unnecessarily bleeding capital through tax inefficiency? A strong financial fortress requires all 6 pillars to be sound, not just a flashy roof.
Because taking control of the variables you can influence is the only way to build a defense against the macroeconomic forces you cannot control.
Well said. The historical models of wealth creation are being tested, and that actually leads to a complex question to carry forward.
What's that?
Well, we discussed how human capital, your specialized skills and labor, is the primary engine for generating the initial wealth needed to buy hard assets.
Right.
But as artificial intelligence rapidly commoditizes intelligence, analysis, and previously highly valued skills, the value of traditional human capital is going to experience its own massive deflation.
Oh, wow.
If the next generation's labor is devalued by AI, while the price of hard assets continues to skyrocket due to monetary printing, how does the algebra of wealth function for our children?
That is a terrifying thought.
Will the ability to build wealth from scratch become structurally impossible, leaving us in a society defined entirely by what assets you inherited rather than the skills you possess?
Wow. That is an incredibly heavy, profound question to consider. It implies a total reordering of ambition and economic mobility. Thank you so much for joining us on this deep dive. If decoding these hidden financial mechanics brought you value, please subscribe to the WealthNetics channel. Share this knowledge with a friend or family member who might be feeling that exact same frustration of working hard but falling behind, and keep exploring these concepts. Take the time to audit your own financial life and take control of your future. because the VIP line might be crowded, but once you understand how the doors operate, you can absolutely ensure that you and your family aren't left standing out in the cold. Until next time, stay curious.